The asset market model. The asset market model theory states that the strength or weakness of a currency is dependent on the flow of capital into and out of a country for the purchase of financial assets such as stocks and bonds. The asset market model focuses on the capital account part of the balance of payments. Whereas the balance of payment theory concentrates on trade flows into and out of a country, the asset market model concentrates on money flow into and out of a country. There has been an explosion of growth in financial assets. More money is flowing into and out of a country for financial assets than money is flowing into and out of a country for trade. In other words, for most countries, the capital account is much larger than the current account. When a foreign government, company, or person invests in a country's financial assets, it affects the exchange rate between the two countries' currencies. Let's break that down. Let's say a person from country A buys stock in country B's stock market. In the process, the money the person paid for the stock is exchanged from country A's currency into country B's currency. This means the person is selling the currency from country A and buying the currency from country B. This adds to the supply of the currency from country A, causing it to weaken in value, and adds to the demand of currency from country B, causing it to strengthen in value. Should a country begin to see an increase of capital flow into the country for investments, they should also see an increase in the value of their currency. Should a country see a decrease in capital inflow for investments, or an increase of capital outflow from the country seeking investments elsewhere, they should also see a decrease in the value of their currency. Asset prices and the asset market model are dependent not only on current holding and purchasing of financial assets, but the willingness to continue to purchase and hold these assets in the future. In other words, traders will not only concentrate on what is being bought now and how much of these assets are currently being held, they will also attempt to determine if investors will continue to hold on to the assets they currently own and how much of these assets investors will continue to buy in the future. Because of the large quantity of financial assets currently being held worldwide, any change in the supply and demand situation for these assets could have a significant impact on both the capital account and the currency value. In other words, because the financial asset market is so large, if there is a sudden change in the amount of financial assets investors are willing to buy, or a sudden change in the amount they are willing to keep out of what they currently own, this would have a huge impact in the amount of money flowing into or out of a country, affecting both the capital account and the currency value. So that's the asset market model, the counterpart to the balance of payments theory. In the next video, we'll look at a theory that concentrates on the driving force of the capital account, interest rates. See you then.